you've ever looked into life insurance, you've probably heard Dave Ramsey say the same thing over and over: buy term life insurance, invest the difference, and never touch whole life type products with a 10-foot pole. And every time he says it, a whole army of insurance agents and financial advisors jumps into the comments telling him he's wrong and that he doesn't understand cash value, that he's doing his listeners a disservice, that whole life is a wealth building tool that the rich have used for generations. So who's right? My name is Jim Eddington. I run Western Pacific Insurance. We help people with life insurance in nearly every state. And on the core issue for most families, I think Dave Ramsey is right. Let's start with what term life insurance actually is, because it's beautifully simple. You pick a coverage amount, say $1 million. You pick a term, 10, 15, 20, or 30 years. You pay a fixed premium every month. And if you die during that term, your family gets the death benefit. And that's it. No cash value component, no investment account, no moving parts. It does one thing: it replaces your income if you're not here anymore. And it does it for a fraction of what permanent coverage costs. Think about a family with 2 kids, a mortgage, and one spouse earning most of the household income. If that earner dies tomorrow, the surviving spouse needs enough money to cover the mortgage, maybe keep their kids in their school, and maintain their standard of living while they figure out the next chapter. A 20-year term policy gives that family a safety net through the years they need it the most, while the kids are growing up and the mortgage is being paid down. For most households, that's the window life insurance needs to cover, and term covers it cleanly. Here's where Dave Ramsey's argument really starts to land. The cost difference between term and whole life isn't small, it's dramatic. For the same coverage amount, you could easily pay 8, 10, even 12 times more per month for whole life than you would for term. That's not a slight difference, it's a completely different line item in your budget. And here's what that cost difference does to families. When someone gets pitched on permanent life insurance, the premium is so much higher that they often end up buying less coverage than they actually need. They wanted $1 million of protection, but the whole life premium on $1 million was more than they could stomach, so they settled for $300,000. Now they're paying more per month, and their family has less protection. That's backwards. Now, the whole life pitch is that some of the extra premium is going into a cash value account that grows over time. And that's true, it does. But how much actually ends up in your cash value and how fast it grows is where things get complicated. When you pay a whole life premium, that money doesn't go all to your cash value. A significant portion goes to commissions, administrative costs, and the cost of insurance itself. In the early years, your cash value might barely move. In many policies, it can take 10 years before the cash value catches up to what you've actually paid in. And here's the surprising part. With most standard whole life policies, when you die, your beneficiary gets the death benefit and the insurance company keeps the cash value. You've been paying into this account for decades and your family doesn't see that money. They get the death benefit you were promised, which is the same amount you could have locked in with a much cheaper term policy. Some policies can be designed to pay both, but you're paying additional premium for that benefit. With term, it's straightforward. Your family gets the death benefit, and the money you saved on premiums was yours to invest however you wanted the entire time. And the growth rate on that cash value, it's conservative. Whole life is designed for steady, modest growth, not stock market-like returns. Even with dividends from a mutual company, a disciplined buy term and invest the difference approach has the potential to outperform it over time. Indexed Universal Life, or IUL, tries to solve this by tying your cash value growth to a market index like the S&P 500. But there are catches. There are caps on how much you can earn in a good year. There are participation rates and spreads that reduce your credited interest further. And you're still paying insurance charges that increase as you age, plus administrative fees. Those costs don't stop just because the market had a flat year. So even though IUL sounds like you're getting market-like returns with downside protection, the reality after fees and caps often looks very different from the original illustration. This is what I see as the core of Dave Ramsey's philosophy. Take that cost difference and put it to work somewhere else. A retirement account, a brokerage account, a college fund, whatever makes sense for your situation. Over 20 or 30 years, money invested consistently in diversified low-cost investments has historically outperformed the cash value component of most permanent life insurance policies. And that money is yours. You can access it, redirect it, leave it to your family. You're not locked into a policy structure with surrender charges and loan provisions eating into your balance. I'm not a financial advisor, and I'm not telling you exactly where to invest your money. That's a conversation for a qualified financial professional. But the principle Ramsey is describing, protect your family with affordable coverage and build wealth separately, makes sense for most households. So if term is that much cheaper and the math favors buying term and investing the difference, why do so many people still buy whole life and IUL? Because the sales pitch is really compelling. You'll hear things like your cash value grows tax deferred, you can borrow against it tax-free, the death benefit passes to your family income tax-free. You're building a guaranteed asset. It's what wealthy families use for general wealth. And none of that is technically wrong. The problem is context. Cash value grows tax deferred, but so does money in a 401k or IRA with better growth potential and lower fees. Sure, you can borrow against your policy, but mismanaged loans can eat into your death benefit or cause the policy to lapse. And if a heavily borrowed policy lapses, that can create a nasty surprise, including a possible tax bill. And wealthy families do use permanent life insurance, but typically for estate liquidity, legacy planning, or business succession, not as their primary wealth building tool. That's a very different conversation from telling an average young family it should be the foundation of their financial plan. I want to be fair here because permanent life insurance is not never the right answer. There are real situations where it makes sense. If you have a large estate and you're dealing with estate tax planning, permanent coverage can provide liquidity so your heirs aren't forced to sell assets. If you have a special needs dependent who will need financial support for their entire life, permanent coverage ensures a death benefit is there no matter when you pass. And even business succession planning, which often gets used as a reason to buy permanent coverage, is usually better served by term. A buy-sell agreement is protecting against a specific event during the working years of the partners. That's a defined window, and term covers it cleanly. Some businesses will pay extra for a different kind of policy, and that's fine, but for most partnerships, term gets the job done. These are specific situations, and in every one of them, the person buying the policy should be working with both an insurance professional and an estate planning attorney to make sure the structure actually fits. But before anyone starts that conversation, ask the basic questions first. Do you have an emergency fund? Are you contributing to your retirement? Do you have consumer debt? If the fundamentals aren't handled, adding a complex permanent policy on top is solving the wrong problem. Get the protection in place with term, handle the basics, and then if there's still a reason to explore permanent coverage, have that conversation from a position of strength. Here's where I land on this one. Dave Ramsey is right for the vast majority of people. Buy enough term coverage to protect your family through the critical years. Keep it affordable. Use the money you save to build wealth in ways that give you more control and better long-term growth. One thing people underestimate about term is the flexibility it gives you. Life changes, jobs change, you might have another kid, start a business, hit a rough patch financially. Term gives you strong protection without locking you into a massive monthly commitment that becomes a burden if your circumstances shift. People get stuck in expensive permanent policies they can't afford anymore, and the choices are ugly. Keep paying under pressure or surrender and lose most of what you put in. Now, I'm not here to tell someone who bought whole life that they made a terrible decision. People buy these products for all kinds of reasons. Maybe they value the certainty of knowing coverage will be there no matter what. Maybe a financial professional they trust walked them through it and it fits their plan. That's their call. What I will say is this: if someone is trying to sell you a permanent life insurance policy and leading with how it's going to build your wealth, take a step back. Ask what the fees are. Ask what the guaranteed rate of return looks like, not the illustrated rate. Ask how long before your cash value equals what you paid in. Compare that to buying term and investing the difference. Do that math honestly, and for most people, the answer becomes pretty clear. If you're thinking about life insurance and you want to talk through what makes sense for your situation, we'd love to help. We write life insurance in nearly every state and U.S. territory. You can get a quote at the link below or give us a call. We're Western Pacific Insurance, and whether the answer is term, permanent, or something in between, we'll help you figure out what actually fits. Thanks for watching.